Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
If you're risk managed, this is the period of time where you got to step back and say, hey, worst case scenario, a little missed opportunity. That's easier to make up for than lost capital if this market turns and accelerates down hard in the September and October.
Well, hello, everyone, and welcome to this edition of Finance U. I'm Chris Martinson, your host, back with Paul Kiker of Kiker Wealth Management. Hey, Paul.
Hi, Chris.
So a little something's happened in the markets between last time we talked, which was last week, and today being the 7th of August. August is the quiet month, Paul. When I was a day trader, I would just take August off. Nothing happens. It's just like the ball ping pongs around, and it's not, there's nothing fun. Whoa. So the story as I have it is that the worst day in volatility since the great financial crisis was triggered by the Bank of Japan raising interest rates by 0.25.
That is correct. Is correct.
Did I miss anything in that story?
No, you didn't miss that at all. And I think I've got a chart of it here that I can show on the screen because it is relatively interesting. So
I find that insane though. That's just nuts to me. Nuts that a quarter of a point. Oh, wow. Look at that.
Yeah.
That's volatility.
Move, huh?
That means markets are as volatile as they've been since the great financial crisis because of a 0.25%.
Pew. And then it takes off. And the best part is just trending down and then suddenly and all at once. Well, hey, Chris, here was my favorite part about it. So the Bank of Japan comes out, over the past day, yesterday, and just basically completely reverses, starts talking, hey, and they're discussing like, we will not raise interest rates during periods of excessive volatility. Well, wait a minute. You raised rates before the volatility. So how are you going to not do anything in the interim period? So, and then they basically kind of job on the markets and we get this huge reversal up, which is not uncommon to see a big bounce on the other side of a decline like that because we're still in buy the dip mentality. I mean, you've got a lot of individuals that are trained to pick up pennies in front of the steamroller, but I do believe that this is a shot across the bow. It's a birth pain. It's a warning to investors, and indexing and buyback blackout going away and buybacks over the next month or so may help the market rally. But we're really not going to know if we make it to September because we're reversing lower today, which is surprising after we were up a substantial amount this morning. If we make it to September, that's when the real fireworks have a chance to start unfolding.
So I worked hard to sort of explain this my way, and I may have it wrong. But, this isn't a sell-off like a bunch of people got together like you and I went to a bar, had a drink, and said, yeah, I'm a little worried about my NVIDIA position, and we both went home and hit the Robinhood sell button at the same time. It wasn't that. This was a liquidity event, right? And I knew Monday was going to be bad because on Sunday night, Bitcoin started selling off hard, right? And Bitcoin is my liquidity gauge. Like people think, it's freedom money and it's the people who spoken. It has a component of that, but it also has a component of being a liquidity gauge. The best one I still have in my toolbox because all the rest of them are a little manipulated, I'll say, right? Controlled.
Yes.
Bitcoin still feels like it has this beautiful, free and wild thing a little bit. And because of that, because it's starting to sell off, I said, wow, this is a liquidity problem right now. And so that's different. It's independent of whether you think NVIDIA is too high or not. This is not stock advice, obviously. You and I, it's just education. But so that was all triggered by 30 years of carry trade on the yen, which you and I have talked about many times in the past. It's this fancy, sophisticated thing where people use money to make money by carrying from a low interest rate environment to a higher one. They make the spread, and they do that with leverage typically. So that's all fun on the way up, and it's a lot less fun on the way down. We started to get that down aspect, that reversal. That's what was started to happen, and that was blowing out, even, as you mentioned, before the Bank of Japan did their old back shuffle. They don't mind if the volatility is upwards. They don't care about that. No, nothing happens, right?
Yeah. Well, on the other side of that, you've got institutions that have been substantially short the VIX, the volatility index. So I think you had two components taking place at once, and this is just an outside observer, so somebody in the options market and the yen carry trade may argue with that, but the volatility index just steamrolled some of those that were picking up pennies in front of that steamroller. And then you've got the yen carry trade and all this forced deleveraging that's taking place. And I saw somebody post on Twitter is like, I thought gold was a safe haven, but it went down too. Well, the reality is, and this is what I tell people, gold is that safe haven, but if you get a big sell-off in the market, gold is going to go down as well, because there are individuals that are stuck in these positions to where it's, hey, I can sell this at just an example, at 80% discount, or I can sell my gold at a 10% discount. I'm going to try to live another day for that other trade. So, when you get those forced liquidations like that and deleveraging, that lack of liquidity, lack of buyers on the other side is what led to that massive event. Worst day, even worse than 1987, 2-day decline for the Nikkei index, going back to 1987. And I've got a chart of it here somewhere. Yeah, let me pull that up and I'll share that.
Wow. Well, yeah. And while you're pulling that up, I'll just cut to this real quick, which is, so this is the S&P, right? And here's, it started its big decline. This is the big, monkey hammer drop right here over these days people are talking about, but it already topped off here starting around the middle of July there on the 15th or so. That was a top, came down a bit, rallied, and then came down hard. And this is today. I woke up this morning to the opening move in the market was plus 75 S&P points, which is pretty bold first move. And it's just been sort of, wobbling that down all day long. It's just sort of been bleeding away. So that's typical. That Paul, the bounce, very typical. But the way I'm reading that is it ain't over.
No, I'm concerned that it's not over. We've been talking about it. Dylan and I have been discussing it on the investment committee pretty heavily. It's like, okay, you get this initial sell-off. What positions need to be sold into the rally, and reduce positions that are down right now, because you get this initial sell-off and then a bounce, and you break some levels of support, which is the same thing we did in the U.S. markets in 1987. You rallied for a couple of weeks, and then, you had that big Black Monday, 1987. And look, I don't know. This is what makes top so hard and so challenging, because you've got individuals out there right now I've seen that are taking advantage. They run risk managed strategies, or they're traders, and they're like, hey, we timed this, great. They set the expectation up that you can time it perfectly. You can't. Some people's strategies are going to get it really good in the short run. Some people are going to navigate better over the long run. But the reality is this is a very, very tough environment. And you have to go against, you have to set those emotions aside. Now, I changed my sign in the back to sometimes defense is just as important as offense, instead of, invest your plan, not your emotions, because I do think defense is important right now. You've got to make sure that you're protecting that capital and making wise decisions. But, we've been trained that, hey, Bank of Japan comes out, hey, let's try to save the day. The expectation is the Fed's going to save the day. Goldman comes out today and kind of throws cold water on the emergency rate cut narrative. That's what the market's screaming for. But the reality is the economy's slowing. How fast, we don't know. We have to look at the revised numbers to see, because of the Ministry of Lack of Truth tells us one thing. And So I think we're coming into that danger period. I mean, I'm mentioned last time I'm on top watch right now, and it's impossible to pick the top. And who knows if this is a dip in hindsight that everybody's going to wish they purchased. But if you're if you're passive and all in, then you're not really buying a dip. But if you're risk managed, this is the period of time where you got to step back and say, hey, worst case scenario, a little missed opportunity. That's easier to make up for than lost capital if this market turns and accelerates down hard into September and October.
Yeah. Well, I mean, in a normal market, right, you have overbought, oversold conditions where you typically expect some kind of a reversal off of those conditions, right? And there's lots of reasons for that. So let's say, what do I mean? Oversold. A lot of people have been selling, and it gets your readings say, wow, this is just, it's gone a little too far. And there's a way that they put those numbers together, right? And so then you get that bounce. The problem is that after a period of excess, when you have a bubble, right? Or like, and we've had a lot of bubbles. Can we just be honest about that, right? Remember, really I'm old enough to remember 2019, right? I hate to date myself, but remember 2019 when there was $17 trillion of negative yielding debt in the world, whatever that means, right? I was like, it's a little bit of a bubble there. Thanks, central banks, a little frothy, right? And of course, that's all been reversing. But the point I want to make here, Paul, is that when markets are really frothy and they finally break, they sell off, they hit oversold, and then they break. So every market crash I've studied that's I call a crash, like it's a big, we're peeling off whole tens of percentages over the next few months. Those all are in oversold conditions the whole time. They crack right through that oversold condition and keep piling on. So that's why I'm watching this very carefully. How's it going to respond? Is it going to be a weak bounce? And that's what we're seeing today. Kind of a weak bounce that it's already red and it was up 75 points. So this is at current trends, this will be a 100-point intraday reversal. So that's really not strength.
No, that is not strength. And yesterday we did not close on the highs. If we were closing on the highs 4 or 5, 6, 7 days in a row, then I'd be inclined to believe that it was a little bit more of a short-term event. But when you have that much damage that takes place across the board, and then there's still geopolitical risk out there right now. So what's going to be the next trigger? This is a dangerous time. And this is one of the things I'm taught to individuals out there about. We addressed a couple of weeks ago the question about, performance. People ask about performance or they look back in their 401ks to see what it is because they don't know what questions to ask. What questions you need to ask, or what are the strengths and weaknesses of an approach. You never want to walk away from a strategy at the weakness, at its weaknesses, and you never want to buy into a strategy at its strengths. So if you've been a passive kind of buy and hold index investor, you're waking up to what's taking place in the world. You're seeing the truth. If they're listening to you, Chris, they care about the truth. We're at about the greatest strengths of a passive, strategy right now. We're close to all-time highs. U.S. has only been the only game in town for the past 16 years, really. So diversification hasn't rewarded you that well. This is about as strong as that strategy gets. And who knows? It may run up another 6 or 12 months, but you want to get close to that period of time. So for someone who is looking for a more wise, kind of prudent approach to manage their assets, this is a good time to start looking away because you're getting rid of you're adapting from, or you're changing from a strategy at its strengths, not its weakness. Bottom of the market in 2008, when the market's down 57%, that's the weakness of a passive buy and hold strategy. You're going to have to endure that. That's not the time that you walk away from that. That's the strength of a risk managed strategy. So you don't want to walk away when you're down 57% to go to risk managed at its strength. What you want to do is walk away when you're in a period of time where the strengths are so strong that it's running on emotions and expectations of investors more so than fundamental financial reality. And that's the problem where we are right now. Everybody's trying to come up with an answer, and yes, the yen carry trade did reverse in the interim period. That's something that has been a birth pain that I think will continue. But the reality is we're in a massively overvalued market, and that's what happens in environments like this. When everybody realizes that the game is over and the music stops, it's suddenly and then all at once, and that's when we get these big declines. And look, if we have a Black Monday like we did in 1987, where we are now, can the Fed kick that can down the road another 5 or 6 years? I would argue that they can't. I think they've reached the point of diminishing returns, and they may do more damage than what they can in good and papering this over in the interim period. Because if they paper it over, well, food prices are just going to get a lot worse, and we might end up in a currency crisis.
We've mentioned this before, Paul, but there's the chance that as goes Japan, so go we, just with a little lag, right? Because Japan has just been in front of the United States. We like to think we're the leaders, but they've been running QE for a decade longer than we have. They've been running the zero interest rate policy longer than we have, right? They have a variety of things, but the thing that always caught me off guard, I think Daniel Lacal really did a good job with this. He said here on August 6th, today being the 7th, so this was yesterday, he said, Bank of Japan, 1, prints insane amounts of money. 2, becomes largest holder of ETFs in the Nikkei. Remember this?
Yeah,
incentivizing investors to purchase Japanese ETFs by borrowing in yen. Oh no, 3, yen falls to 40-year lows. 4, Bank of Japan blames speculators, a classic. 5, Bank of Japan spends billions stabilizing the yen. So those blue lines in that chart below, that's holdings, Bank of Japan holdings of ETFs. It's such an extraordinary number. It's unbelievable. Like, if you ever heard that I'm sure you have, the old saw, the old joke about trading, where there's a gentleman who decides he wants to go into egg futures, so he buys some egg futures and they go up. And he's like, "Oh, this is good. I'm making money." So he buys some more egg futures and they keep going up, and he keeps doing this and he keeps buying more and more and it keeps going up. And then finally one day he's like ready to ring the cash register. So he goes to his broker and he says, "Sell all my egg positions. I'm ready to retire in the Caribbean." And the broker says, "Well, to who?" He says, "Well, to the egg market." He's, "Sir, you are the egg market."
That's great. And for those who haven't spent much time in the markets,
Yeah.
if you think hard about that, you'll understand it. There's nobody to sell to because,
Yeah.
that's great. Doesn't do you any good to corner a market if there's nobody to sell to.
No, but I mean, that's the Bank of Japan. Look at them. They are the egg market here. They've literally, it raised so many issues for me at the time, Paul, which is it's because they are majority holders. Does the Bank of Japan have a seat on the board of these companies?
That's a good question.
It's very weird from a governance standpoint. Anyway, they overdid it. And even despite all of that Bank of Japan ownership, even despite all the printing, it still broke on them.
Yeah.
So to all those people who are holding on to this idea, well, the Fed will bail us, they'll print us out of this. You might want to have a little caution on that strategy, because it might not happen.
Let me share this. This is actually a really good piece right here. If I can, so the Bury Tracker, and I'll watch what he puts out from time to time. Posted this on Twitter, and I thought or X, which was pretty interesting. So he said, he's got a thread. He's said, how big are we talking about the yen carry trade and what they're doing? Massive institutions were involved in these carry trades, and the balance sheet is vastly larger than the country's GDP at 127% on the Central Bank of Japan. Okay. Fed's balance sheet is at 25% of GDP. So the BOJ balance sheet is about 5 times more influential on their market. Look at this. Since 2010, look at just how substantial that has been. That puts it in perspective, doesn't it, Chris?
I'm sorry, I can't quite make it out. What's the blue line? What's the red line?
The blue line is the Bank of Japan balance sheet, and the red line is the Federal Reserve balance sheet. So
in the same nominal terms, or is this percentage of GDP?
This is a percentage of GDP.
Wow.
So they're at 120%. They're at 127% of GDP. We're at 25% of GDP.
So that would be like as if the Federal Reserve, instead of having a $7.5 trillion balance sheet, would have a $38 trillion balance sheet, roughly.
Yeah. So you look at that. Now, going back to 2013-14, that was 30% of their GDP. It's absolutely incredible. So,
well, it's insane. They're absolutely nuts. They're nuts, these people. Nuts.
Yeah. And the problem is you've incentivized a world of institutional traders and investors in the financialization of our economy to go out and take advantage of that. And I can't help but think, if I go back, because this just came to mind. Let me find another chart. Because, around 2014 is when that really took off, and that's about the time that the U.S. markets really started outperforming the rest of the world. And I didn't think about it till we started talking about this, but I do want to share it here. That's about the time the U.S. really started separating from all of the other asset classes. So if you can see my screen here, the black line is the S&P 500. This is going back to January 1st of 2008. Around 2014 is when that took off. And all of the other asset classes have stagnated, but yet the U.S. markets have grown relatively dramatically in comparison to everything else about the time that accelerated. And then on the shorter term window, what I'm showing here is the Japanese yen versus the U.S. dollar. So Japanese yen against the U.S. dollar, so that shows the weakening. That green line is the NASDAQ 100. So no correlation through that, 2020, but NASDAQ rallies, on all the money that's printed in 2020 after the COVID shutdown. We have the market correction, potential recession that never happened in 2022 or slowdown. But look at how this reversed right here. So just as soon as the yen started strengthening against the U.S. dollar, I mean, that's a straight correlation. The moment it turned, the NASDAQ 100 turned. So is this just been a continuation of that carry trade that's fueled out of the U.S. markets into the Magnificent Seven? And if that's the case, if that yen strengthens at some point, there's not any easy decisions going forward. So you can have a massive deleveraging event occur, not only in the yen carry trade, but also just the valuations that are out there if we don't get this perfect kind of fantasy world soft landing or no landing over the next 12 to 15 months with real estate shut down like it is. It's hard to imagine that we're going to end up in a Goldilocks scenario. It's possible, but it's hard to imagine. I think the market is starting to understand that. And those creaks and popping that you were talking about back in the spring are starting to be board snapping now. I think that was one board that snapped. The question is can we continue the journey with that board snapping and others not snap? But when the stress comes again, that's the birth pain that's just going to get more severe until this situation is resolved.
Well, so here's why I think that, this is why that's the central banks, why they ride into these rescue operations so quick and so furious right now, because they learned their lesson in 2008, right? Listen, if a couple of collateralized debt obligations went belly up, the problem is once you had that first layer where, oh no, Bear Stearns, and then, oh no, Lehman, right? Once a behemoth the size of Lehman, which was very big at the time, goes belly up, now it's everything under that, right? So you've got all these hedge funds that have been borrowing, they have lines of credit, and now they have these other trades, and those are connected to this and that and all of that. So they can't let that get down a couple layers. So that's why when I said this was a liquidity event, this isn't a couple of people going, maybe I should sell some stocks, right?
Right.
When you have a liquidity event, they have to stop it in its tracks, because if it goes 2 layers deep, now you have a different problem on your hands, because now you have the worst thing that could possibly happen, which is a loss of trust. Like, I don't know if you're broke. You don't know if I'm broke. None of us know if they're broke. And it just goes on. And then the whole thing freezes. And then I hate to say this, Paul, but that brings us right to the conditions that we were talking about when we were talking about the great taking, which gets activated when one of these intermediaries freezes up. And suddenly, let's say it's a clearinghouse for derivatives, right? Let's say magically they were like the settling house for yen futures, right? And oops, somebody, couldn't make good on those. Or maybe they were housing a big old block of interest rate swaps. And suddenly, you had big movements on interest rates as a consequence of this. Then all of a sudden, if that intermediary is like, oh no, we couldn't quite true up our margin accounts and margin calls and all of that, and now our capital gets dinged, we're done. We no longer can make good on this $6 trillion of derivatives we were supposed to be backstopping. All of a sudden now nobody knows. Like, I don't know, Paul, if you're good for it. You don't know if I'm good for it. We don't know anymore.
That's right.
That's when things go bad, and that's when I could see the mechanisms of the great taking getting activated, because the one thing they can't risk is for the system to freeze up. They can't risk it.
Well said, Chris. And my great concern is FDIC insurance and regulations came about because the banks failed in 1929 and everybody lost everything, right? If you had your money in the banks, it was gone. SIPC insurance is there for broker-dealer failures in the past. The derivatives market, as Warren Buffett talked about being these mass weapons of financial destruction, what supervisory bodies are out there? What limits are there? I mean, technically, you can have derivatives on just about anything, and we're so financialized because they are sexy, right? Retail investors are doing it. Institutional investors are doing it. I have people tell me from time to time, in the professional industry, it's like, buying stocks is so boring. You want to dress it up and put a little nice cocktail dress on it and buy some call options and some put options. And That was a horrible statement to make, but you know what I'm getting at. You want to dress it up and make it look really pretty, and instead of just buying the individual stocks. And that's my concern, is that if one of those counterparty blows, then you're, like you said, that's the fuse. That's not the fuse. That's the detonator to bring about the great taking if all the counterparties fail. I mean, that the world changes the moment that happens.
Well, and this brings us, but when people say, oh, well, would they let that happen? Like, no, but how do you prevent that from happening? So right now, retail level, sorry for anybody if this offends anybody, I don't mean to, but retail level is, oh, well, the Fed cut rates. They got the shiny keys. They're like, look, we might cut rates. Yeah. Paul, cutting rates doesn't do squat anymore. No. Rates have nothing to do with liquidity. That's a separate set of shiny keys. Correct. Rates, okay, the Fed can pay less or more on interest and excess reserves, turn the interest rate dial. Who cares, right? At the margins, that'll help. Can I get a car loan for 7 instead of 8.5%? Fine. But that doesn't change the problem. To get to a liquidity problem, the Fed has to print money. Mm-hmm. Full stop. That's what they have to do. Right. And we found out because of the FOIA acts in the context of the great financial crisis, and the Fed didn't want to tell anybody, but Bloomberg finally got it out of their hands, that over the course of the next year, they had made $21 trillion of liquidity loans to everybody and their uncle all across the world. Foreign central banks, private equity funds, anybody who needed it, right? Just sidle on up to the window, and the Fed had your back on that whole thing, right? They would have to do that again. And so the point is that that's going to lead to more inflation, because that's just money printing. So I predict that they're going to have to go back to money printing before the election, and the weakness in the market kind of makes me think that.
Mm-hmm. At least at a minimum, it provides cover. And you're right. If cutting interest rates had made was that instantaneous, now it'll fuel speculation. But I mean,
you get a pop, but
they kept interest rates. They wouldn't have had to keep interest rates for as low as they did for as long as they did if it was that much of a magic bullet. Like, they had to do that. I mean, from the 2008 crisis, and now we're back to a reasonable rate where you can earn on your savings. Still doesn't keep up with what's taking place from inflation at this point. But yeah, my concern is how can they do this without inflation? To get rid of deflation, let the markets drop. But if they come in and print, cut interest rates, speculate, that may be the straw that breaks the dollar's back at some point, or crushes the bond market. And then how's the government going to finance their debt? This is, we've heard of them being painted into a corner for over a decade now. The reality is there's people who saw that coming well in advance of the average person, and that doesn't mean that they're wrong. There's an argument, hey, if you're early, you're wrong. If you don't change your mind and the information changes, you're wrong. Just because you're early and you saw it before everybody else doesn't mean that you're wrong. It just means that actually you took a lot of pains so that you could warn people out there and give them enough information and time to grasp the concept and do their research themselves if they're not too lazy to do it, to prepare and protect themselves. We need people to warn us ahead of time. So I don't like that perspective of the financial media where they say that.
I know. So I would remind everybody, go watch The Big Short, because you brought up Michael Burry. You brought him into the conversation, right? And I love that scene where in the movie, not played by Michael Burry, but his character, it says at one point he's getting yelled at by his investors, like rah rah rah, because he's losing money because he's early, Yeah. And at one point he says something like, I might not have this, I might not be right, but I'm not wrong. He's just like, but I'm not wrong, and he wasn't, right? So
no.
So early you also mentioned geopolitical. I just wanted to go there real quick because this really surprised me quite a bit. I didn't think Ukraine had it in them to do something like this, but apparently that his forces, Kremlin's announcing his forces thwarted a major ground assault from Ukraine into Russia's southwestern Kursk region, and fighting 2 days, and they attacked indiscriminate shelling of civilian buildings, they're claiming here, residential houses, ambulances, blah, blah, different weapons, up to 1,000 militants. It did, I'm not clear what the goal here was, because Ukraine's been hemorrhaging a lot. This looks like something trying to get a provocation to get this kicked up into a higher gear. And of course, listen, if you're in Europe, like the idea that Ukraine is now directly attacking gas facilities that are still transiting gas into Europe, very bad idea here. So again, as you and I have talked about, this represents a form of risk that the markets just hadn't been pricing in. And maybe we're starting to see some of that, early snapping back to like, oh, maybe risk does exist,
Right.
as a concept. It really does, but somehow we forgot that.
Right. I mean, I in my 26 years and in studying history, in my opinion, these are the riskiest markets that I've ever seen. I mean, that would be a fact from my standpoint. These are far riskier from what I see, what's taken place in investor complacency from what took place in 2007, 2008, before things came apart. The difference is I'm seeing the same behavior that took place in the housing market in 2007 in the housing market now.
How
And
so?
in the
What are you
stock
seeing
market
there?
now. Well, it's slowed a little bit because it's frozen, but just that belief. People are in more camps where back in late 1990s, everybody started chasing technology stocks. Nobody really paid attention to housing. Nobody really was paying attention to anything else, because this was the new shiny toy that everybody was looking for. Well, that bursts. A lot of people get hurt, but then they're able to fuel the next bubble, which is in housing. Well, housing seems to grab a lot more people than what the stock market did back then because of the fact that more people are involved in their houses are going up. And then you get that speculation, and then everybody needs to own a house. And we know what took place back then for the sake of time without going through everything. And then you get this housing bubble that bursts and the credit crisis that's on the bottom side. Well, now you've got that same mentality that's taking place in housing. You got a lot of individuals that own multiple homes from rentals at this point. So your wealthier class owns a lot of extra homes now because rental rates have gone up. They're starting to soften a little bit. There's been the argument that we're underbuilt. I mean, the data, at least in Georgia and parts around the country, new homes, existing homes are hard to find, but new construction's coming along relatively rapidly now. So then you've got the stock market bubble. You've got all these different bubbles that are out there. So I think that it's just much larger this time. And I keep looking for the asset class that's going to protect when the bubble bursts. That's really hard to find. I really do like gold and silver as an alternative, not a recommendation, folks. I'm just saying that, but we have to understand those are going to go down as well if things come apart. Treasuries are a great place to park right now because you've got perceived liquidity, but you're earning a decent rate of return. But at least as a U.S. citizen, that's the safest asset that you can own technically because it's backed by the full faith and the credit of the government. But I don't think that that's going to be the right asset to own from a long-term standpoint. It's going to be the alternative to peel back, when you're playing defense, protect that capital. But then if they come back with that major printing response on the other side, then right, treasuries are not going to be the thing to own. And the thing that concerns me is if they don't let the deflation play out and just inject enough money to cover all of your SIPC insurance, your FDIC insurance, and to just hold the foundation of the system together, but go ahead and let most of the house burn down where we can build back. If they don't let that deflation take place, which would wrench all of this wealth out of the top 5% and distribute it, we would have a closer to a middle class again. I don't think they want to allow that to happen because they're going to lose control. That's what needs to happen. It's the most just, it's the most fair. But if they don't, I believe, my thesis is once we get that deflation, they're just going to print like nobody's business and universal basic income and all of that. That's the point that I believe an investor is going to have to understand there's no conservative way to protect yourself against inflation, right? There's no conservative way for a retiree to invest to protect yourself against inflation. It'd be nice if you could go out and buy inflation protected treasuries if the government was telling the truth about inflation, and that may be a tool. But if we end up in a currency crisis on the other side of it because our deceitful ways as a federal government causes the BRICS and other countries to provide an alternative to the dollar that's decentralized, 40% backed by gold, that unit that we have talked about a few times before in the past, and at some point need to talk about it a little bit more. But once you have an alternative and you've got dollars that are, international dollars that are fleeing to that, then we have a nightmare scenario of high inflation. And investors, I hope we don't see that, but we have to be prepared for it, and we have to have plans in place to adapt your investment strategy, especially for a retiree, because you're going to have to protect that purchasing power going forward. Now's the time to play defense, in my opinion, and protect capital. But there's going to come a day in the future where you're going to have to embrace volatility.
They say that you always fight the last battle,
right?
And the Fed is desperately afraid of deflation, right? The Great Depression, Ben Bernanke, it won't happen on my watch. And so they've done everything they can because they're just desperately afraid of that. I'm a little confused by the Germans for a lot of reasons, but one of them is that their last monster was inflation, right? Mm-hmm. That Weimar inflation set the stage for a lot of bad things that came afterwards, right? So you would think they'd be a little more cautious about the whole inflationary side, but if we're at that point, Paul, where we're on that knife edge as I see it, right? And you're going to have to pick your poison. So you've said, well, let's take the deflation. You know what? The top 5% gets pretty trimmed. That's fine, but maybe we can keep the system intact and we carry on, right? But they don't want to do that because the top 5% are the people who will not invite them to the cocktail parties going forward, right? So that's a non-starter, right? That will directly hit my sense of self and importance as a Fed person. Somebody will actually give me a frowny face at Bridge Club. I can't stand that, so it's not going to happen, right? So they're going to go the other way, right? And they're going to push us to inflation. And if I had to, I'm a betting man, so I'm actually hedged both ways, but it's not even.
Right.
I'm hedged about 15, 20% for the deflation side. If it happens, I'll have some dry powder. I'll pick up some stuff on the cheap. The rest of it is all inflation hedged because I'm just playing the odds.
Right.
Given the chance, unless it gets away from them, they are going to print and create inflation because inflation ruins everybody's lives except the person across the card table at the Bridge Club, right? Those people are insulated from this stuff, right? Paul Krugman, I don't know, what do groceries cost? And he has no idea, right?
Yeah.
And by the way,
go ahead.
Did you see somebody ask Kamala about inflation? And it was one of the most torturously ignorant statements I've ever seen in my life. No. Right? She couldn't even get the concept down. She's like, well, bread costs more and that stretches the family budget, so we take it very seriously. They were like, what are you going to do about it? And the answer is simple. You want to hear my answer? Yeah, we're going to cut that deficit spending from 6.8% of GDP back down to 3 tops, and we're going to tell the Federal Reserve no more expanding the balance sheet without explicit congressional approval. There, next question. All done. That's it. Because inflation spending is where you print money that you don't have and you spend it. That's inflation. There it is. She's like, milk, she's clacking her fingernails together. I'm just like, oh. Get ready for inflation, folks.
That's still a terrible answer, but at least it wasn't. Well, inflation, is inflation, and inflation is inflation, and inflation. So,
well, there was some of that. I was condensing.
So, but yeah, I mean, it's heartbreaking. It's terrible that that's the path that they're going to take. And again, like I said, very well said. You've got some dry powder set aside, and you've got some hedge. That's one thing. Again, for those listening, I can't give a specific recommendation to you individually. You got to talk to your advisor about it. But the government limits your ability to purchase I-bonds, which are pretty good inflation hedges from a long-term standpoint, to $10,000 per person per year. So that's something good to be averaging into with some of your, I still think people need 12 months worth of emergency fund in position, and hey, businesses, build up because that's opportunity money. But that's something that I would encourage people to take advantage of if it fits their situation. Talk to your advisor.
If I buy one of those I-bonds with my $10,000 limit, can I sell that to somebody else?
Well,
or does that go run into to their $10,000 limit?
So, that's a good question, Chris. That's actually a really good question. Well, you have to buy them directly through Treasury Direct. So I'm assuming, I don't know if the government's buying those back or not. I've actually never thought who was on the other side of that trade.
Yeah, I don't know.
It's my
Never bought one.
understanding that it's my understanding the government just absorbs those. So there are a couple things to know about on the I bonds. You really got to look at them for about 5 years, because if you sell them prior to the 5 years, then you're going to give up 6 months worth of interest in a interim period of time. And
Okay.
if we have deflation, so it kind of works like the 6-month-old CD penalties. If you sell them, you give up interest over a period of time. They pay every 6 months, and they're going to adjust based on inflation. And what you have to be concerned about is if we have deflation, you're going to get a 0% return on those. But if we have inflation, I believe in 2023 for a period of time, the interest rate was like 9.25%, somewhere around 9. This is approximate. So, you did get a base return and then addition. And I don't have those facts in front of me right now. It just popped in my head and I wanted to share it. But you're limited to that. So, like an LLC can buy it, an individual can buy it, a custodial account can buy it. But from a long-term standpoint, you're not going to get a good yield right now. But if inflation returns, which I believe it will over the longer term, the little bit that you can purchase is a good hedge.
Well, good. Hey, while we have everybody's attention, I just want to mention that the summit isn't that far away. It's August now, so we're about a month out from our Peak Prosperity Summit. And we're going to have conversations just like this. So for anybody who's thinking about coming, it's in Winnipesaukee, Lake Winnipesaukee, New Hampshire. And it's September 13th, 14th, 15th. So that's Friday, Saturday, Sunday. And we're going to have an incredible finance panel on that, the money panel, right? We got Lynette Zhang coming. You'll be there. I'll be there. We're going to have the CEO of Goldcore is going to be there, David Russell. I think also Stephen Flood will be there. And we're going to have EQRP guys there, which is for people who have individual retirement account stuff. Yeah, I think Josh and company are going to be there. So we're going to have this incredible panel. So I just wanted to, for anybody who's thinking about coming, you got to come. Not just for that panel, but Paul, I don't know if there's going to be any more. That's my uncertainty about the future now includes the idea that I can't plan more than a few months out in the hopes that we can count on it being there. I hate to be that sort of macabre about it, but I mean, I really am serious. This is going to be a very important one where we also get to talk about, I know you got a farm, I got a farm. We're going to be talking about things way beyond money, about what we need to do given what we think is coming, and things we can only really talk about in person. So anybody who's thinking of coming, trust me, you don't want to miss this. Not this year. Please come.
Well, even last year, Chris, just the conversations we had around the campfire and after the events and in between events and while we're sitting there eating, just the collective wisdom of people that love the truth I met some ridiculously intelligent individuals there that are specialists in their categories, and to have truthful and honest conversation. It was one of the most enjoyable events that I've been to ever. Because, every now and then you'll find one or two people you get into good conversation with. But in this, every single person I ran into was great conversation. So I encourage people to come too. It's a great event and build relationship with wonderful people across the country.
Well, the prime benefit is you find out not only are you not crazy, but the people you're not crazy with are very successful, very curious, very interesting folks. And that's important to know. So that's why I hold it, because I want people to know that same thing. I'm in a catbird seat. I have a very special job, Paul. I get to talk to a lot of people who are like this, and that's a great blessing. But a lot of people don't have that. So that is the blessing, is to get them together, and then they get to, like that. That's it. I could get laryngitis for the whole weekend and not say a word, and the whole thing would be just a smashing success. It'd be awesome.
It would still be successful. If you couldn't talk, it would be missed because you're eloquent and you say things well, you see clearly, and you're good at getting conversation started. So we don't want you to have laryngitis.
I know sign language.
At first when I saw that, I was like, what? And then I was like, oh, it was like I was sitting there. How did I not see that to begin with? Are you still planning on doing is it the Bayesian experiment? Is that what you explained?
Oh, yeah.
That? I don't know why.
Yeah, it's one of the most important things.
I'm like a kid in a candy store. I'm so excited about that. I can't wait to participate in that.
I can't either, because, it's an experiment and we want to find out the collective intelligence of people. I got a way that we can see what people collectively think is going to happen. And I believe, this is me The WF, the Davos crowd, Paul, they hate the crowds. They think the crowds are dumb, and what do they call us? Useless eaters, right? So they believe in their own supremacy and all that stuff. I actually believe that more people are intelligent than fewer people if you can get them together in the right way and let them really honestly express themselves. I actually believe in people. So this is a way of summing across all the people who are going to show up. And I can't wait to see what the answer is going to be,
Me too.
It's going to be good because we're going to ask a lot of really tough questions and find out what everybody thinks. It's going to be awesome. Well, for anybody who wants to talk to Paul and his amazing team, better get on the list because they're quite busy at this point. And you go to peakfinancialinvesting.com, fill out a simple form, and somebody from Paul's team will get back to you. So again, Paul, just such a pleasure working with you and your team and helping people with things they really need help with at this point in time.
It's our honor. It's our honor. And I will encourage, so if there, if any of you out there, if you know anybody that gets rattled by what's taking place in the markets, they don't know if they've got a good plan in place, they're not sure what to do, they're asking questions and they're being, looked at like they have horns growing outside of their head, then give us a call. Even if it's just to answer questions and point you in the right direction, we would be honored to have the opportunity to talk to you. If we can make a difference in your life for the better, everything else will take care of itself. That's all that matters. Excellent.
Well, until next time, Paul, thanks so much for your time again today, and safe trading.
Safe trading, Chris. Curious to see what will happen between now and next week when we see each other again.
All right. Until then, everybody enjoy. And I hope you got something from this. And please leave comments down below. Anything you want to hear us talk about, always open to taking topics and suggestions and questions. So, yeah, please let us know what you want us to talk about, and we'd be happy to do that. Till then, bye, everyone.